morning. Today is Tuesday, June 25th, 2013. And again, Todd is out this week, so my name is Craig Hill and I'm filling in for him. And yesterday we talked about institutional buying and selling activity and using a weight of evidence approach to identify, high probability trades, likely turning points in the market. And today I want to build upon that and talk about utilizing the average true range for trading and how one way to use it. So if you look here, we've got Occidental Petroleum, OXY, stock OXY. It's just actually setting up. We've already had a first retracement in here, right in this area, on this pullback in here. Okay, which would have been a good trade to the upside. Profit objectives would have been hit, per the TC method. And if you're a retracement trader, chances are you would have been looking that's about 25% of the pullback from this low up to this high. So if you normally trade off those fibs, that would have been a good trade. And the market did put in a new high on that move. So technically, we've got continuation of trend. So chances are, you may have been looking to position in again somewhere right in here, okay? And you could actually look to position in again in here, scaling in this area, okay? Now let me show you something you can use for a tight stop. You've got this 50 moving average, or the 50% fibs from the low up to the high, sitting right there at those moving averages. These moving averages are typically identified as longer term support or resistance. You can see how they work pretty well. Once we broke up through here, we saw continuation. The market pulled back, got a little bounce off of it. So these moving averages work very well to identify longer term support and resistance. One way to trade, there's a couple ways to do this in here. Some examples I'm going to just go over. One, you can wait for the inside vertical bar to potentially form in here, okay, as it is today. We'll see if it closes like that. Or if you wanted to trade it automatically, okay, you could buy it in and around that 38% fibs, somewhere around there, okay, around 88, 90 or so, pretty much right where we're trading at, okay, and then use the ATR. Here's your ATR, guys, 1.79. That's currently your ATR. So that's a $1.80. So on average, what that means is that on each day, this market moves an average of $1.80 each day. And so what I've found is if you split that in half, that gives you 90 cents. Okay, so you can use that as a gauge to tell you, okay, well, if half a range is 90 cents, then I'm going to place my stop 90 cents below where I think the market may pull back to and bounce. And, again, here we've got confluence. Okay, we talked about this yesterday. Weight of evidence, confluence. We've got the moving averages right in here. You've got the 50% fibs. Okay, so chances are if the market does pull back this far, sometimes it doesn't. Other traders recognize, hey, if we don't get in now, we'll miss the trade. So sometimes it won't pull back this far. But if it does, and it does take it out a little bit, chances are using an ATR, percentage of the ATR, about 50% of percentage of the ATR below that major support level will keep you out of the natural ebb and flow of the markets. So in this situation, you'd have a stop in here. 86.40 minus 90 cents would be 85.50. So you have your stop right in there, 85.50. Okay. You could trade this automatically and do that, or wait for the price pattern, and then place your stop half an ATR below the low of the bar prior to the price pattern. The inside bar, if that does in fact form an inside bar today. Okay. All right. So, and then if you were to trade this in here, your target would be about 50% back up to the high of the day for that first profit target, and then you split it for the second profit target. Now, remember what I talked about yesterday about profit target trippers? Notice in here that you normally be looking somewhere right in here for that second target. Guys, look, got a lot of consolidation right in there. So nothing wrong with bringing it down just a little bit. It's a higher probability that trade's going to work out. Okay? So that's one trade. And also notice one thing about the ATR, it's universal. Okay? Notice here it's at $1.80. Now let's look at another stock. Okay? Let's look at Intel. We've got some similar situation with Intel. Okay, we're in an uptrend. The market's pulled back. We could draw our fibs from the low up to the high here. Look at this. Again, we've got the same situation. We've pulled back into some longer term support. Okay. Technically, this is this really, I mean, here's really the first, almost this, well, technically it's second or third. It depends on how you want to do the math. This is where the market really ran away. This is the first pullback after the market kind of got away from moving averages. Made a new high, pulled back. You could see the bullishness in here, and you got a retest failure, but the market's just pulling back into some longer term support. Okay, you've got a low risk, high probability, low risk, high reward potential trade here. By the fact that it's pulled back to some deeper term support. So this is Intel. You can apply the same principles. What I love about the ATR, it's universal. So, if you use 0.5% on OXY, you could do the same thing with Intel, and it's going to adjust for volatility because you're using the ATR. You're not using just 90 cents. If you go 90 cents from here, you don't need that. That's too large of a stop. Right in here, you see the average range is at 54 cents. So this stock only moves 54 cents on average a day versus $1.80. So if you go 50% of 54 cents, what is that? 27 cents. So all you need is, you can do the same. You can apply the same principles. You've got the 50% fib sitting right in here. Okay, you've got your moving averages right in there. Okay, this is some longer term support. So you could just bring your stop down and put it 27 cents below that. Right around 2309 minus 30, 399, 89, 79. Right around 2285 or so. You can place your stop. You don't need to give it any more room than that. Because chances are, and especially if you get an inside bar in here, then you're immediately bringing your stop up in this area. So a couple of things, you can trade it automatically right now today, and then look for your first target being about 50% of the move back up to the high in here. Okay, and then your second target right in there. And now this is the second target. On the other stock we looked at adjusting that just underneath the consolidation. The second target, it's perfect. The trading plan, if your normal second target would be perfect in here because it falls below where there's a potential profit tripper. So and so a couple ways to approach this. You can trade this automatically right in here right now at the 38 of the day. You've got a great setup in here. Second, potentially third retracement, but it doesn't matter. I mean, it's pulled back to some longer term support, and we should get some follow through to the upside. In any case, your stop, if you're taking on automatically, you've got your stop down here about 27 cents below the 50% fibs. If you're going to wait for the inside bar to close, look at it tomorrow. You're going to place your stop below the low of this by 27 cents. Okay. So back on the ATR, again, guys, it's universal. It's universally applicable to any market. So for example, a 27 cent stop or 27 cent offset below major support on this stock will work. If you do that at an OXY, chances are you're going to get whipsawed. You need that extra, 90 cents. You need that 90 cents. I found this works the majority of the time. So if you apply these type of principles, this is one way to use the ATR to apply it to your trading. Use a percentage of the ATR to offset, just to give the market or give your stop a little bit of wiggle room. Give the market a little bit of wiggle room so you're not crowding the market too much. Because one of the questions I had when I first started trading is, well, yeah, okay, well that's major support. You could draw a support line, but you throw it right up on there, chances are you get whipsawed by using a percentage of the ATR. Offsetting that major support or resistance. Chances are you're going to give it enough room. You're not going to crowd the market too much, and you're going to give enough room for just ebb and flow. Okay.